These solutions are not people-centric. Everybody has a unique situation. Personal finance is very, very personal. It is not something that can be generalized across people because everybody has a unique situation. So this
Exactly. So that is
cannot.
the whole point, that is the entire crux of the question also that I asked you, Aditya, because we talk about diversification so much, and just because it's a category that's providing you exposure across asset classes doesn't mean that it qualifies or tick marks all the diversification criteria that maybe you need in your portfolio. It is not investor specific diversification. I think we should just hold on to this, Aditya, and just explain our viewers as to what does it mean to have an investor specific diversification and how that is not provided in these multi asset allocation funds, Aditya.
Definitely, ma'am. So personal finance is personal. So let us explain this
Right.
to our viewers with two examples. There's one 50-year-old who is nearly approaching his retirement in 10 years, and there's one 20-year-old who is starting off his investment journey. For both of them, you cannot have the same asset allocation through this multi-asset fund. Both of them will have a very different asset allocation. The 20-year-old will be very aggressive and the 50-year-old will not be that aggressive equities and will be trying to wind down his equity exposure. So net, both of them cannot have a solution where both of them invest through a multi-asset fund. What they have to do is they have to go to a financial planner, or if they are do it themselves investors, they have to go through an asset allocation process where an asset allocation decides what is the amount of investment that should be going into each of these asset classes, and then from there on they have to take it forward. So net, as I was trying to say, and as you have also alluded to, a multi-asset fund cannot replace a traditional asset allocation. What it can do is within one fund it can provide you diversification, so it can prove to be a complement to an asset allocation but not a replacement to an asset allocation.
Exactly. It can be a complement to a diversification strategy that you might have adopted in your portfolio, but then still, let's just also take you through the other classes, across which these funds are diversified. So, Aditya, we are aware of equity, debt, and gold. Typically, these are the three asset classes which are involved in these kind of funds. But then we're also seeing funds that are coming up with commodities and maybe real estate via REITs. Now, that's a tricky place for a lot of investors. Not all of them would want to put their money in commodities. A lot of them might not even know how the commodity market works, and maybe it's just too risky for them. Also, REITs. We all know this particular investment instrument is yet to take off in the country. Although we are seeing REITs being launched, but then still it's not something that investors are really gaga about it or maybe aware about it. So help us understand, in a multi-asset allocation fund that has a commodity as an asset class, in terms of exposure, and has a REIT, how does it work, and what kind of a risk appetite one investor needs to have?
So very good question. So now MCX, which is a commodity exchange, funds can take exposure to the commodity side of it as well. So how do commodities really work? When inflation is tending to move up, commodity prices do well, and commodities make a lot of money. When inflation is tending to move down, commodities don't do too well, and they don't make that amount of money. So it can be a small part of your portfolio, but it cannot be a large part of your portfolio because it works reverse of the economy. Point number one. Point number two is 5 to 10% can be there in commodities, but generally when we do an asset allocation, we generally tend to not invest in commodities as such because we don't feel that that's a very important asset class that the investor, if he will not invest, he will lose out. Within commodities, we are already investing in gold, so that's not a problem as such. Now, if we move on to the real estate exposure, yes, these funds take exposure through real estate investment trusts. As you already said, they are very slow to take off. There are some taxation problems as well, and they are getting solved. So net REITs are a good option. 5 to 10% of your portfolio should be there. However, my suggestion would be do a pure play asset allocation. Then, if you have some amount of money left, go to a multi-asset fund. But rather than that, a pure play equity exposure, pure play debt exposure, and there are so many ways to get gold exposure and real estate exposure as well. That could be a better option in the longer term rather than going to a multi-asset fund. This could be good for investors who are looking for a one-stop investment shop.
So, Aditya, I just wanted to understand one thing that do multi-asset allocation fund also provide you with international exposure?
Some of them do, they do really provide, but most of them don't take international exposure. They restrict themselves to the domestic exposure. And anyway, as you know, the international exposure, as per the RBI limits, is not allowed at this stage. So most of them are domestic equity-oriented mutual funds.
Also, let's discuss the tax implication involved, okay? Because as an asset class, we know that there's equity involved, there's debt also involved. So, what is the tax category these kind of funds actually fall into, or and how beneficial it is for the investors?
So what really happens is uh, these funds are taxed according to the equity exposure that these funds have really got. So if the exposure is from 10 to 35%, they are in one tax slab. From 25 to 75%, they are in one tax slab. So the tax slab varies according to the exposure that the funds have really got. So the now with the indexation benefit also going away, so that's a real challenge. So according to me, a pure play equity allocation makes much more sense where there is just 10% long-term equity tax and 1 lakh is exempted. So net, the taxation will vary, but on a pure play equity exposure, taxation is much more simpler than these kind of.
So far, could you help us with the data in terms of what kind of multi-asset funds are available and how has been the performance since the launch? I mean, it's a pretty new category, and yeah. So I mean, we don't have like a huge track record of past performance, but then so far, how are they performing?
So what happens is one of the major problem with multi-asset funds is that you cannot compare one multi-asset fund with another multi-asset fund because the exposure of equity, real estate, debt, and gold will vary across mutual funds. So it is very difficult to understand what kind of a return profile that you should be expecting. In my opinion, a 12 to 15% return profile is what you should be really expecting out of these funds. You cannot compare these funds because, as I said, every fund manager will have a different exposure to all of these funds. What asset funds, uh, compare the Sharpe ratio and then go ahead and invest in these funds.
Also, Aditya, let's focus on the fund manager's role, okay? Because so far you've given us the pointers or the triggers or parameters through which you should be really looking at the fund's performance. But then, how do we also track the fund manager's strategy and the calls that they take? Like, for example, we are at a market high right now. So, how should we understand the change in the fund manager's strategy as far as the fund exposure is concerned across asset classes?
Again, very good question and a very difficult question to answer. So what really happens is there are multiple fund managers involved in these kind of funds because there are multiple asset classes that are there. Basically, what the fund managers are trying to do is they are trying to time the equity markets by saying that if they find the equity markets to be overvalued, they will move to other asset classes. So right now at this stage, what I feel is that the equity exposure should be upwards of 50 to 65% because in our opinion, as fund managers, we don't see that the equity markets are going to stop anytime soon. So in my opinion, over a longer period of time, the fund manager should stay invested anywhere between 50 to 65%. That could be a good strategy. And on the debt side of it, the fund manager should be invested in long-term debt funds because we are now on we will now back on an interest rate cut cycle. So again, very complex question to answer as such because multiple fund managers and multiple strategies are involved here. But long-term debt funds for now, long equity exposure of anywhere upwards of 50 to 65%, that should be a good strategy, and that's what investors should look out in the multi-asset.
All right. So, one very basic question that also we've seen a lot of viewers asking us, Aditya, which is so typically in a portfolio, people usually have equity, okay, in their portfolio, and some way or the other, they are invested in gold, and real estate is also a part of their portfolio. It might not be aligned the way it should be as per their goals, but then some kind of an exposure and some component of these asset classes they have, and also fixed income through different type of investment instruments. Now, tell me one thing. I mean, obviously, the diversification strategy depends on the financial goal that you have attached your portfolio with, okay? But typically, when we talk about diversification and the and rebalance and revamping your portfolio, we would see a fund manager doing it in a multi-asset allocation fund. At the same time, you as an investor, and maybe if you have a very well diversified portfolio, you too have to follow that particular rule of diversification and rebalance your portfolio as per the change in the investment or the market environment, right? So is there any way, I mean, it's a very hypothetical question and maybe a question that, you know, investors who are really well learned can follow, but if you understand a fund manager's strategy and if you think it's aligned with your goals in the portfolio, can you sort of follow that for your portfolio also at large? I mean, I don't know if it's advisable, recommendable, but then that's just a question that people ask because they tend to follow fund manager's strategy a lot. So that's why.
A simple parallel I will draw. Uh,
Okay.
if you go to a doctor and you understand the doctor's medicine, it does not mean that the next time you have a disease, you will be getting the same medicine. What really happens today is markets are fast moving, equity markets are fast moving, and you get information from the fund manager with a time lag of 15, 20, 25 days only at the end of the month when the fund manager portfolio is out. So net, it is very, very difficult to follow a fund manager strategy one-on-one. First point. Second point is those fund managers work 24/7 on managing your money. Most of the people don't have that time to manage, to work 24/7 to manage their money since they are into a job. So a better strategy could be, if you want to do it yourself, work with an advisor who will help you out with all of these things. If you don't have time, then what you have to do is then you have to go to a multi-asset fund and stick there. But I will suggest that it is better that you go to a professional advisor who will take care of your asset allocation every 6 to 12 months. And I don't believe that people will not have the time to look at their portfolio for 6 to 12 months, because if you don't take care of your money will not take care of you. So don't do it on your own. Take some professional advice, professional help that will help you in the longer term. So 6 to 12 months is the broad horizon where you should be revisiting your asset allocation, and that's not a too hard a task to do.
All right, so Aditya, I think we've really discussed a lot on multi-asset allocation fund. Thank you so much for being on the show and helping our viewers with this category today. And we'll take a quick break, but then post that we will meet Parul Gulati, founder of Niche Hair, and we'll also have Harshvardhan Rungta to not only answer your queries, but then also give you more tips on your entire investment strategy. All of this after this break.